if you refinance, are you still paying a title company or closing costs, or how does
Yeah,
that
you
work?
still got closing costs. In fact, that's about the only cost that you have. Okay, so this is another misconception about refinances, that they're super expensive. So
Right,
out of
that's what I've heard,
pocket,
so.
yeah, and out of pocket, it might feel a little bit expensive. But let me kind of break down some of the numbers for you, okay? Mostly what you're paying, the actual cost that you're paying for a refinance is escrow, title, recording, kind of what's known in the industry garbage fees. It's a whole bunch of little fees that add up to about, on a $300,000 house, maybe $1,800 a month, or $1,800 total to close, okay? But what you do have to do is you have to refund your new escrow account. So you're going to prepay property taxes and insurance, okay, for a year or 6 months or a year, kind of depending on when you're closing. But you're going to refund that impound account. That's that account that you pay to your mortgage each month that then comes out once a year and pays out your property taxes and insurance. So
Right.
when your actual money out of pocket funding that escrow, it isn't going to be $1,800. It might be $4,000 or $5,000, which can be rolled into the loan, by the way. But
Oh, okay.
that $4,000 or $5,000 is not cost to you because of the refinance. It's money that you're going to spend anyway on insurance and
Right.
property taxes. It's simply that
over time.
you're just funding this new loan that hasn't been funded. But here's the bonus, okay? You currently have a mortgage with an impound account, and that impound account may have $1,500, $3,000, $4,000, depending on where you're at in the cycle during the year. You've been paying to that account every month. So when you're done with your old mortgage, you've refinanced, you have your new mortgage, and you're going to have to fund that account. You have your old account that has money in it. Well, you get a refund on that, right? Anything that didn't go to pay towards insurance and property taxes, you get. So you're going to pay. You're going to pay some in, and then you're going to get some back out, and that number should be pretty close to a wash. It's not always exactly on.
Equal, yeah, that's what I was thinking. Okay. Well,
No, it should be really close. It should be close enough to where it's not a hit to your pocketbook.
Burden.
But what
Right,
people like to do is they like to go ahead and roll that $3,000, $4,000, $5,000 of funding that new impound account into the loan. So your loan balance goes up slightly, but not because this is the misconception, not because the refinance is costing you an arm and a leg. It's simply that it's going up. We're raising the loan balance so that you don't have to come out of pocket that amount of money. Right, so you don't have to come out of pocket that $4,000 or $5,000.
So if you don't have the cash to come up with that, there's a way to do it, still save that money and roll it into the loan.
Exactly, and then you get that check back at the end.